Today's podcast is sponsored by Fintool. Still control Fing through SEC filings? There's a better way. Meet Fintool, the chat GPT for SEC filings and earnings transcripts. Just ask your question and Fintool pulls the best answer from relevant documents, whether it's a snippet from an earnings call or a key point from a filing. The best part, every answer comes with sources, so you know exactly where the information came from. That's their read, but let me give you a little bit of my experience. I've been really interested in gaming stocks recently, so I was looking at Caesars, and Caesars has been built up through a slew of mergers over the year. I wanted to see their thoughts on how the synergies from these mergers had evolved to kind of judge them on these mergers. Previously, that would have been a half-day project. I need to pull up every earnings call for the past 5 years. I need to go through it, control F for synergies, probably read through it because sometimes they don't say synergies directly. They say like merger benefits or something. And I'd have to go through all of them and see how the thoughts on synergies had evolved. But with Fintool, it only takes 2 seconds. I just say, what did Caesar say about their Eldorado deal synergies? And Fintool gives me a quote and a link to the source. In this case, it points me to Caesar's 2023 proxy that's noted they'd exceeded their stated synergy target. And then if I want to do more, I can ask them some different questions and find out more about how the synergies have evolved over time. Good luck finding that with Control F in just 2 seconds. So look, if you're an analyst or a portfolio manager, try Fintool today at fintool.com and take your research to the next level. That's fintool.com. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on, I believe it's for the third time, my friend, the founder of Plural Investing and Hidden Gems, Chris Waller. Chris, how's it going?
Thank you, Andrew. It's great to be back. Thanks for having me on for a third time.
Chris, it's the third time, which for those on the YouTube, the question is, where's the hat, my friend? Where's the hat?
Yeah, it's a good point. I do have that hat somewhere, but I haven't got it with me right now.
Well, look, let me start this podcast the way I do every podcast. A quick disclaimer, remind everyone on this podcast that nothing on the podcast is investing advice. That's always true, but I'll add an extra disclosure. I can only speak for myself, but I think I speak for Chris too. I have a position in this stock we're going to talk about today. So you should keep in mind that I am very much talking my own book as well as Chris is talking his own book. So we've got those disclaimers out the way. Chris, the company we're going to talk about today is Seaport Entertainment. The ticker here is SEG. As I mentioned, I have a position in it. You did a fantastically detailed write-up on your site, Hidden Gems. I'll include a link to it in the show notes. And I say fantastically written because when I have a position the size that I have in Seaport, I generally don't expect to find anything new when I'm reading write-ups and stuff. And you had some nuggets and especially some on-the-ground research that I was like, oh, these are really interesting. Some thoughts on some developments and everything, but we'll probably talk about all that. I just wanted to mention how good the report is for listeners. Why don't we back up a bit? And you kick us off with, what is Seaport Entertainment?
Yeah, thanks, Andrew, and thanks for the comment on the report. So Seaport Entertainment is a company that was spun out from Howard Hughes in July of 2024. As many of the people watching and listening may know, Howard Hughes is a real estate firm, but this company, Seaport, had a collection of assets that was very different from Howard Hughes's traditional business. And so the company was spun out for that reason. Now, Seaport or SEG is a collection of loss-making and complicated properties, primarily in the Seaport district of New York, but they also have some assets in Las Vegas. This is a pool of assets that have been essentially dragging down Howard Hughes' stock for a number of years, and I think the stock's probably been sold off by former shareholders since the spin. Just to give you some context as to why I thought this is really interesting, my estimate is Howard Hughes invested about $1.5 billion over a number of years into this pool of properties. Today, Seaport's market cap is about $250 million, and the company has $50 million of net cash. That's split roughly $115 million of debt and a little bit of preferred stock, non-recourse on 2 of the properties, and then about $160 million of cash. When you take a step back, many of these properties are in an area of New York that should be attractive. The Seaport District is in Lower Manhattan. It overlooks the Brooklyn Bridge. It's on the East River, and it's about 10 minutes walk from Wall Street. And so this is really an area that should be prime real estate, but has been neglected over a number of years. Howard Hughes invested to rebuild some of these properties and construct new ones, but they don't really have a background in entertainment and hospitality, which is really where the new management team are coming in and looking to take this destination. So both the new CEO and CFO have the right background, I think, for this. They both moved their families to New York to take this opportunity, and I think their upside is going to be largely determined through the stock price rather than their base compensation. So I think that gives a good indicator that they believe they can recover, certainly a good chunk of the value. And the stock today is at about $20 per share. I think that they could probably recover it to about $50 in 3 years' time, which obviously means there's quite significant upside. I also think that a couple of these properties are in a more stabilized position, meaning that we can more reliably estimate what their values are. And those properties alone, I think, cover the entire market cap today. And then you get everything else, which I think has a lot of upside, but is more uncertain, but you in some ways get that for free. And so I quite like the risk reward from that perspective. And just the last thing I think worth commenting on is Pershing Square owns 38% of this business at the time of the spin. Bill Ackman was chairman of Howard Hughes for 13 years, including at the time that this spinoff was announced. Interestingly, although the spinoff happened in July, in October they did a rights offering to essentially fund the company with cash to cover the current losses and make the investments necessary to turn it around. Pershing Square backstopped that rights offering at $25 a share. And in fact, what that meant was they could have ended up owning up to 70% of the company. In the end, the offering was oversubscribed, and so they didn't need to do that. But they did add another 2% to their position through the oversubscription privilege, and so they own 40% of the company today. And that's basically where things stand. And I can give you an overview of which are kind of the key properties, but maybe we'll talk about that in a second.
Yeah, that's a great overview, and it's so funny because Seaport, you can go like, and as you've done and as I've done, you can go really granular and go down to the Seaport district and start inspecting like literally building by building, or you can just say like high level, a lot of costs into these things. Look, let me start off. There's lots of areas I want to go and discuss with you here, but let me start off with the general question I always like to start off with. The market is a competitive place. What are you seeing that the market is missing that makes you, and I disclosed I've got a position too, me, believe that this is a risk-adjusted alpha opportunity?
Yeah, so the disclosures with this company were very limited, certainly on a property by property basis. There's only really one property where you can get financials for, which is a food hall called the Tin Building, which is losing a lot of money, and I'm sure we'll definitely be getting to that. But essentially, all the other properties, including what I think the most valuable property, is Pier 17, which I think could be worth as much as everything else put together. You cannot get property by property financials, and there are just very limited disclosures. So I think what a lot of investors are seeing is a cash burning and very complicated pool of assets with limited disclosures. They own a ballpark, they own air rights, they own undeveloped land, they own a food hall, they own a pier, and it's quite difficult to get a handle on what is this really worth? How does this get turned around? And I think as a result of that, a lot of the focus from investors right now is on cash burn, particularly at the Tin Building. And so that is really, I think, the big focus, when in fact, I think most of the value at the company is going to be around the pier and the neighborhood more holistically, rather than one specific property in the Tin Building. So I just think this is one that you can do a lot of diligence and uncover a lot of the economics and the detail, which the company is not making easily available.
Let's start. I want to talk about a lot of different assets, but let's start cash burn. And I say that for two reasons. Number one, you mentioned the Tin Building, and we'll talk about the Tin Building in particular, but it is not lost on me that I believe it was in mid-January, there was an article published that was, I can't remember if it was a quote or if the headline was, I went to the food hall that's losing $100,000 per day. Because the Tin Building is losing $100,000 per day. And it's not lost on me that since that article came out, the stock has been like straight down. And the number one question I get from investors on Seaport is, on the cash burn. So we'll talk individual properties and stuff in a second so we can put Tin Building aside, but I just love to talk overall the cash burn. Like, go look at the financials. Anyone can look. The cash burn is very high here, and yeah, they've got a ton of cash on the balance sheet, but you can't burn cash this long and have cash on your balance sheet. So I'd love to talk just about the cash burn, what's driving it, and what the outlook for it is.
Yeah, so just to put that into context, they just released results for Q4, and that is a quarter where the new, first quarter post the spin-off and post rights offering as well. A lot of the changes have not taken place, and this is a seasonally weak quarter because the number of visitors to this location is much higher in the summer. So just to give everyone some context, operating cash flow in that quarter was negative $7 million. Equity losses were another $9 million, and that is where the Tin Building is booked because it's actually an equity investment. So that's about $16 million in one quarter before CapEx. Now, in terms of maintenance CapEx, there isn't a lot because of the nature of these properties, but there will be some growth CapEx to redevelop these properties. So that will come on top. So that's obviously a lot of cash burn for one quarter. I think so. What you can see from that is, about half, or maybe even a bit more than half, of the cash burn is currently at the Tin Building, and there's a number of things we could talk about as how they're going to bring that down to zero. But I think there's really sort of a few big levers the company can pull at a high level. One, at the Tin Building, there's a lot of cost cutting that I think is possible, and we'll go through what that is. The second thing is just if you look at the central cost, the corporate expense of the company, it's been, just massively inflated. If you look at their previous financials, and the company is doing a lot to bring that down, and they did actually bring that down in the quarter, and they talked about how there's quite a bit more they can do to bring that down. And then the third thing is which is probably the most important thing in the long term, is just to increase the number of people going to this neighborhood. That is the single most important thing. This neighborhood of New York, it's about 10 minutes from the subway. It's a little bit out of the way for New Yorkers, and there just are not enough people going to this area. And the cash burn at the Tin Building is partly a symptom of that broader problem. And this is where the Pier 17 and the attractions they're bringing to it and what they're doing at some of these other properties are really going to help increase the number of people coming to this neighborhood, which is then going to improve the economics at all the buildings.
I want to pick out a point there that you had, because it's another thing that I talk to people and they debate with. So the Seaport, as you mentioned, for those who don't know, it's like southern Manhattan all the way down by kind of the Fidei, and it's about a 10-minute walk from the subway, and it's also against the water. So I've heard people push back on, like, hey, they control. This very simple bull case is they control a whole district in Manhattan. How often do you have the chance to do that? Like, if the old cliche is real estate in Manhattan goes up, like, you control a whole district, you can zone it, you can plan it, like, that's going to be worth a fortune over time as this city continues to grow. And the pushback I continue to hear is, hey, it's against the water and it's 10 minutes from the subway. So you're actually missing something. Whereas, like, if you're in the middle of Manhattan, you have people who can come from both directions and you have really easy access to a subway. They'll say, hey, it's a 10-minute walk. You've got the water on the other side, so the density isn't great. And they'll push back on a lot of that. So I have my own thoughts there, but you're the guest. I'd love to get your thoughts on kind of that pushback on, is the district really that valuable, good?
Yeah, it's both a strength and a weakness, and the management, or the previous management, did not do a good job on capitalizing on the strengths and mitigating the weaknesses. So where it's a weakness is if you build a food hall like the Tin Building next to the water, on one side you've got no people coming in because it's on the water, and on the other side there's actually a highway. So it's a bit out of the way. It's not like Italy, which is a food hall concept, typically in the middle of numerous office buildings. And so you have those office workers coming in every day. So if that's going to be the concept, then the location is going to be a big problem. And that is one of the reasons why the Tin Building is losing so much money. Where it can be a strength is on one of the key properties they have called 250 Water Street, which is a currently undeveloped piece of land, but zoned for a 545,000 square feet built residential building and an office building. That's going to have views overlooking the Brooklyn Bridge and the East River. And so that's really going to make those apartments, premium apartments. So basically they have to reorientate this. If you look at the Pier, for example, it has a rooftop. It overlooks the water, the Brooklyn Bridge, the Manhattan skyline, and it's been highly successful. And so I think it's really just about how does the management change the concepts to take advantage of this. The other thing I would just say is that actually, if you go back sort of 15, 20 years, this was a popular destination for workers in the financial district after work. And because it is within walking distance. And it was a very busy neighborhood for that reason. What happened is it essentially got neglected. There have been other developments on more the west side of Manhattan, so around One World Trade Center and different shopping malls and concepts there. And then Hurricane Sandy had a very significant impact on the seaport being on the water. And so you've got these different factors, which has meant that a location that should really be a strength has actually become a weakness. But I think that can be turned around.
A reminder that today's podcast is sponsored by Fintool.com, the chat GPT for SEC filings and earnings transcripts. Just ask your question and Fintool will pull the best answer from the relevant documents, whether it's a snippet from an earnings call or a key point from a filing. If you're an analyst or portfolio manager, try Fintool today at Fintool.com and take your research to the next level. That's Fintool.com. Yeah, no, look, I completely agree with you. And look, would you rather the location be, in Times Square, right, where there's 100 different subways and you literally get off and you're in? Yeah, sure, but a price for everything. And there are plenty of examples of things on the far out Upper West Side, some of the things over like some of the developments kind of just south of Hell's Kitchen that are very, very far from the subway system and are still hugely successful. And as you said, like the water is both a blessing and a curse. And a price for everything, to me, I look at this at the 250 million market cap, and we'll definitely talk 250 Waters in a second. We can talk the stadium, we can, like all these different things. I just say, hey, it feels like you get multiple ways to win, and not a lot of ways to lose. One thing I want to mention before we start diving into the things, I would be remiss because people can, if you Google around, you will find my write-up on this pretty quickly. And one of the things that initially attracted to me here was the setup. Howard Hughes, I'd encourage anyone who's interested in the idea, go read Howard Hughes' history here. For years, they were saying this was going to be like the premier development in all of Manhattan. They thought they were going to sell it to like a sovereign wealth fund for a 2% cap rate or something. Go read other history here. But the thing that attracted to me was this was a spinoff into a rights offering. And whenever I hear spinoff, my ears perk up, and whenever I hear rights offering, my ears perk up. And a spinoff into a rights offering, I haven't seen one of those done since before I was an investor. These are the things, the legends. That's what got me involved. I just quickly want to talk about how this came out and kind of maybe the opportunity set and overhang from that, if all of that makes sense.
Yeah, I think the background is Howard Hughes is a company that they believe they've successfully developed a lot of these master plan communities where they have a lot of control, but their share price hasn't, in their view, really reflected that. And meanwhile, they have this collection of properties in Manhattan where there is some control, but it's not a master planned community, and it's losing a lot of money, and it's an unusual set of assets. And so the company and the analysts and investors were very happy to essentially get this spun off. This was the bad co, whereas Howard Hughes was the good co. And so that is why you have this setup where the stock has been dumped by those prior shareholders who are quite happy to get rid of it. And it is a very small percent of their stake in Howard Hughes. And at the same time, you have Pershing Square, which knows the asset very, very well, backstopping a rights offering in order to provide it with the capital to make the changes necessary. But you've then also got a lot of these shareholders who really just bought in for the rights offering. what the rights offering meant is you could buy stock, and you would have the ability to oversubscribe and buy more stock at $25. So if hypothetically, if the stock was trading at 30, you could, through the rights offering and the oversubscription, get additional stock at 25, sell it at 30, and exit and just make that kind of arbitrage. And so you've had this technical trading dynamic, I think, since the rights offering, which has meant that there's been a lot of selling pressure and not really a lot of fundamental buying pressure.
If I could just jump in with one thing, I think one of the interesting things is heading into the spin, they were clear. We're going to spin off Seaport and we're going to do a rights offering at $25 per share. And for every share you own, if I remember correctly, you got about 1.7. You could buy about 1.7 more shares in the rights offering. One of the things that jumped out to me was the 25 was set before they spun Seaport out. Like they didn't know what the stock was trading for in the market. So I'd love to just, where did the 25 come from? Because everyone anchors on the 25. Like, how do you think that 25 number was chosen?
I mean, I suspect that, that's obviously a price that Bill Ackman thought would be, incredibly attractive and really a number where you almost couldn't lose over time, because he was willing to ultimately own over 70% of the company, which I don't think is something, even though it's a relatively small amount of capital for Pershing Square. I think owning 70% of a publicly traded company could bring complexities. And so I think he was very instrumental, obviously, in setting that price and thought it was very attractive. I don't know you might have some thoughts yourself as well.
No. No, that's my understanding, because look, it's just really interesting because you have a spinoff that's being negotiated before, and the rights offering price is being negotiated before. The company knows that they need cash, and because it's a rights offering and everyone has the chance to participate equally, right? They could set it at $1 if they wanted. They need a level that lets people participate. But to me, like I think now things can change over time. Obviously, we're 6 months post spinoff, the different world today. But I think that 25 price was a big signal. Ackman said, "I will take every share you can give me. You will give me at 25." I think it's a big signal that he saw value much, much higher than that. And he could be right. He could be wrong. But I think, again, I've got a position here. I think the odds are he's going to be right.
And the stock's at 20 today. So we're getting it at a 20% discount to what an, extremely discounted price was supposed to be.
We're going to go to all the individual properties in 1 second, but since we mentioned Ackman, we might as well talk about it now. The other big question that I get here is it's cash burn. Will the Seaport be attractive? And the third one is Ackman. And, he owns about 40% of the stock. And I also don't think it's not lost on me that since he made the offer to take over Howard Hughes in quotes, but basically inject money into them and turn them into an externally managed company where he's going to charge a fee, it's not lost on me that the stock has lost about 20% of its value since then. And the market has been volatile. There's absolutely no doubt about that. But I think a lot of people have started to look at Seaport and said, hey, Ackman owns a lot of this thing. It is really small. Like, could we run into capital allocation, control, those types of issues? So people have started saying, hey, is this getting an Ackman discount? So I'd just love to get your thoughts on that.
Yeah, it's a tricky one to answer. There was a theory at the time of the spin-off that Ackman wanted to facilitate this in order to make an acquisition or merger with Howard Hughes much easier, because you wouldn't have this sort of complex loss-making asset where there could be very big differences in opinion on what this was really worth. So that was a theory. But I think that there are a lot of ways that Howard Hughes could have spun this off. I don't think Pershing Square, backstopping a rights offering and potentially owning 70% of the company was the only way this could have happened. I think there are a lot, if he just wanted to sell this asset or have it spun off, he could have done a normal spin-off without backstopping, a rights offering. So there are easier ways to do this. So I certainly don't subscribe to the theory that this was just all a spin-off, at any price, even if you lose a significant amount of capital through the Seaport stock, just to make, Howard Hughes purchase.
And I would just say, like, look, the amount of money they raised in the rights offering was $200 million, which is not an insignificant sum, but they structured this as a spin into a rights offering. If Ackman wanted absolutely nothing to do with this, I mean, basically all of that $200 million came from Ackman, right? If Ackman wanted nothing to do with this, he could have said, "Hey, spin it off, Howard Hughes, $200 million. You guys can just put the $200 million in there, whether it's in the form of a prep or you guys give it to it. Like, it doesn't matter." It's like, to me, the fact that he wanted to put money in is a signal of the value, right? He wanted more of this thing, and yeah, I will do. I generally have a lot of respect for Ackman. I've talked to him like a few times in my life, so I can't say we're friends or anything. We've got by his Twitter account, we've got divergent opinions on quite a few things as well, but I've generally had a lot of respect for him as an investor. I think he just sees an opportunity to make money. I don't think we're going, for him to go and pull what he's pulling with Howard Hughes here. Cool. It's a $200 million market cap company. You're going to get $2 million of management fees if you get this externally managed, and maybe torch your reputation by kind of turning this into a weird, complicated, externally managed shellco. I just don't see the upside downside. I just, maybe if the stock was a lot higher, but I
there
think
are actually a couple other positive things I would say is, one alternate theory as to why the company really didn't communicate so much and did not really disclose too many details about the economics of the buildings or lay out the pathway ahead at the spin could have been, if you want to sort of get a little bit more conspiratorial, that maybe Ackman wanted the stock to trade below 25, in which case he would have ended up with 70% of the company and then perhaps done a full acquisition afterwards. So arguably his incentive was actually to take it all at 25. The other thing I would say is that, if he really believes that these assets are incredibly cheap at 25, then, the lower and lower you go, the more likelihood is that he might just buy the whole thing. Now, maybe with a Howard Hughes deal happening at the same time, perhaps these couldn't, both happen. But I would just kind of put that out there as there is actually a potential acquirer who's shown interest at $25.
Interesting. From today's price, you say 25. I'm like, oh, that'd be a pretty nice mark. But man, let's talk about it. Let's talk about some of the individual properties because I just think there's so much more value here than 25. I want to start. Team building gets most of the press, and let's go to that second. But let's start with what I think both of us believe is the headliner, because there's also been news here, and I know a lot of people are like, oh, Q4, there weren't a lot of results. These guys just got into the seats. I actually think the results they're driving are pretty good here. So let's start with Pier 17. And I'd love for you to quickly give an overview of what Pier 17 is, and then maybe we can talk about the big new lease that they've got there.
Yeah, so Pier 17, as the name suggests, is a pier right on the East River overlooking the Brooklyn Bridge. There are really three parts to this building. So there's a rooftop concert venue, which has been quite successful, and that will be expanded throughout the year. It's been primarily a summer concert series so far, and management have announced that will now go year-round. There's then at the ground floor, currently 5 restaurants and a couple smaller concepts. Some of those have worked pretty well, some of them have not. The biggest space, which is about a quarter of the entire space, was very unproductive, almost empty at times. And that has now been released to a new concept called Gitano, which is a restaurant stroke nightclub. And that will, I believe that actually had its opening this week. So that's been a very quick turnaround in that regard. And then you've got 3 floors of office space. Now, I believe it was about 215,000 square feet, if I make sure I've got the numbers right. But there's a significant amount of office space that is currently about half empty. And the reason for that is this pier was designed before COVID. And obviously since then, office demand in Manhattan has structurally reduced. And so that office space has become incredibly unproductive. And the single biggest task, I think, facing this management team is to redevelop that into an entertainment and hospitality space to then bring the large number of visitors required to the Seaport area, which again will then benefit all the properties. And there was a very big announcement at the recent results on this exact issue, which is that a concept called Meow Wolf, so MEOW, Wolf, WOLF, has leased 75,000 square feet of that office space. So that is an attraction that has been successful in, I think, 7 or 8 locations across the US. It's a concept the CEO knows very well, because when he was managing City Center in Vegas, there was a Meow Wolf competitor in that area, and it attracted, I believe, over 1 million visitors per year.
Can I pause you there for a second? So, as you know, I think you're on the fence, but I'm going to Planet Microcap in Vegas in about a month. If anyone's going, reach out. But one of my things, I love escape rooms. So I went on all my escape room blogs, and you obviously have the invite. I was looking out escape rooms to do in Vegas, and 2 of them said, hey, you've got to check out this Meow Wolf thing. It's an interactive thing. I believe one review called it Interactive Sleep No More. So I already knew about this thing, and then they announced the deal. And as soon as they said it, I was like, this is perfect for what Seaport needs. It drives hundreds of visitors per day. And that's great because hundreds of visitors per day, they go to Meow Wolf, they interact. Obviously, it's going to take up a big space. But then those visitors trickle out through the rest, right? Maybe they want to get a meal after they go through a 3 to 4 hour room. One review I saw called it an interactive Sleep No More, which it was maybe they want to get a meal, maybe they want to go grab a drink, whatever it is. But it drives the foot traffic there. So to me, I still can't kind of believe the stock wasn't up on announcing this. They get a 20-year lease, exactly what you want, drives visitors, drive traffic, gets that whole flywheel going. I just wanted to give my background and views with it, because I thought it was perfect, exactly what you wanted in this space.
This is going to be the single most important thing that the management does to turn this company around. It's a concept that has been successful in 7 or 8 locations. You can Google it, look at the Google reviews, look at the number of ratings. Obviously, there's no guarantee that just because it's been successful everywhere else, it will succeed here. But I think, that's true of every concept. This is as close to a guarantee as you will get. It's an immersive experience that's been really successful. And if you did this kind of thought experiment, on the west side of Manhattan, you have, the Whitney Art Museum. If you could teleport that into Pier 17 with all the visitors that brings, it would make the whole area successful because of the number of visitors it would bring. Well, that's sort of what this concept is supposed to do. And if you look at sort of the numbers and try and put some numbers to it, I think the Pier today attracts maybe 1 million visitors per year. It's very hard to know because no one really discloses this, but if you add up the concert venue and the restaurants and the offices and so on, I think it gets to maybe just under 1 million. This particular concept in Vegas attracts over 1 million, just one concept. And the CEO on the earnings call, he talked about hopefully over 1 million in New York as well. And New York will be the sort of biggest and most impressive build out and the newest build out of this. So, we can't guarantee it will work, but I think the indications would suggest this is going to bring over 1 million visitors to this area, more than doubling what the Pier is currently bringing.
If I could just add one more, I completely agree with everything you said. If I could just add one more, you mentioned ESPN had a big office space here. Their studios, if you watch if you watched Get Up in the Morning, I don't even have cable, but if you watch Get Up in the Morning, there'd be Mike Greenberg, and behind him, there'd be this beautiful view of New York City. Like, that is where the ESPN studios were. And that is a great tenant to have if you are of an office building. But it is a terrible tenant to have if you are trying to design something that drives a lot of foot traffic. Why? Because, think about that beautiful view. The ESPN studios, it's 3 anchors and maybe 2 cameramen behind it who are taking up 100,000 square feet, 5 people. You replace this with a Meow Wolf, which during the day could be driving hundreds and hundreds of visitors. That's going to be so much better. That's hundreds and hundreds of more people who have the potential to go hit some retail stores, go buy some food, all that sort of stuff. So I just think it is just check. It was an AA plus signing, and I'm very excited to have them there. I'm very excited to go to Meow Wolf in Vegas because now it's a research trip. It's no longer Andrew just having fun, and I'm very excited to go in 2027.
And
anything else you want to say about Pier 17?
yeah, I would just say, I mean, I did not think they would make such a big move and get an anchor tenant like this in so quickly.
I thought it would be next year. I thought it would be a next year thing. Yep.
Yeah. So this was really impressive. And also they're not finished. I mean, there is still probably half the space at the pier, which they can do something with. And, you know, if they got something similar and instead of bringing an extra 1 million people brought 2 million, that would be a huge home run. So I'm excited to see what they'll do.
And just to think about the flywheel, you know, let's just imagine it was a one floor, right? Before, if you were shopping half the floor, then the person had to say, hey, well, the other half's empty. I've got to drive all this traffic on my own. Now, if you're shopping half the floor, you say, oh, Meow Wolf will be there in about 18 months. They're going to drive 1 million people. So if I build, you probably don't want to build another interactive art exhibit, though in Japan, I believe there are several places that have interactive art exhibits right next to each other. But if I build something, I can piggyback off some of that foot traffic. Like I know there are going to be 1 million people per year, and I can try to drive them, and I can build a concept that plays well with what's going on there. So I just think that's interesting.
And it's all about getting those multiple spending points, because right now you go to a restaurant and that's it. There's not really a natural second opportunity to spend, but now you can go to Meow Wolf and then you can go to the Tin Building. You know, so it's all about bringing in multiple opportunities to spend in that one area.
You can go to Meow Wolf, and then you and I actually was texting with another mutual friend of ours. We need to plan a value investors night out at Lawn Club, which is another one of their things, so that we can, you know, have fun, see some other value investors, but also take our value investor friends' money and put it into Lawn Club and indirectly into our pockets through Seaport. Let's talk about the next building. This is the building that gets all the press. This is the Tin Building, and if I'm being honest with you, this is where I thought you did the best work in your report. You've got the comps to Italy and everything, so I'll just back up. Why don't you describe the Tin Building, what the vision was for it, why it's been so bad, and kind of why you think it can turn around?
Yeah, so the Tin Building is a luxury food hall and market, which has about 15 to 20, depending on how you want to count them, concepts. So some of these are restaurants. It's about probably half of the revenues of this building are restaurants. There is also cafes and bars in there. There are also there's a grocery store or grocery section, and also several retail sections. So the idea was to take the Italy concept, although they don't like to be compared to Italy, but where you have, you know, grocery and retail and restaurants all in one environment, and then make it much higher end. So it was actually modeled off of Harrods in London. Although, to be honest, it is very luxurious for a food hall. I don't think it's really comparable to Harrods, but, you know, that was the idea behind it. So right now, it's generating just over $30 million a year in revenues and about $70 million a year in expenses. And so that is an enormous gap that needs to be bridged. And you can imagine it's pretty daunting actually looking at those numbers at first glance, thinking how on earth can they even bridge a gap that big? I do think that there is a way to get to break even. I don't believe that this building is ever going to make a substantial profit. And that is why I say in my, you know, valuation, this company gets a lot of press, but in some ways it's actually not that important as long as they can right size those losses, because it's never going to be a highly profitable business. Seaport are also the landlord. So they generate about $10 to $11 million a year in rent. So they do get that rental income, which is quite valuable. And there are really, and so the Tin Building is also a partnership with Jean-Georges. So Jean-Georges, as some people may know, is a very famous high-end chef and restaurateur. He has restaurants in Manhattan, but he has also a business of a group of many restaurants across the world. And so this is actually the Tin Building by Jean-Georges, and that's part of the branding and why it's so high end. The issue, I think, up until very recently has been really not just a flawed set of concepts, which was too high end, too much retail, too much grocery, which just doesn't work in this location because it's not next to office buildings. But also, I think, quite distorted incentives because the Jean-Georges company was managing the building. And so Jean-Georges effectively gets paid in two ways. Seaport put up the capital, or Howard Hughes put up the capital. But then Jean-Georges would get a share of the profits. But he's also providing all these services, all the staff and so on are provided by his company. Now, because the building has lost so much money, there is no realistic prospect for Jean-Georges to make money off of future profits because Seaport has the right to earn back all the existing losses. So effectively, you no longer have any profit motive. But if he supplies more services, he does get paid off of that. And so his incentive is to supply the maximum number of high quality services, which massively increase costs. And maybe it boosts revenue, maybe it doesn't, but it certainly increase costs. And that's really his incentive. And so that's a very fundamental issue that needed resolving. And the other thing I was very impressed with management on is in January, they announced that they had effectively taken over a company called CCMC, which is the company Jean-Georges used to operate this building. So effectively, what we're now going to see is the Seaport company will be the operators, not just the suppliers of capital. And as a result of that, you're probably going to see a big reduction in costs, some of which has already begun, and also a change in concepts to restaurants. And so the rough math of how do you get to break even with $30 million of revenue, $70 million of cost? I think what's ultimately going to happen is that they're going to cut costs from roughly 70 to 50. And by reorientating the concepts, I think they can get revenues from 30 close to 50. And so maybe the last bit of that will require Meow Wolf and other concepts to bring visitors to the area. But I think that's what they ultimately try and do. And just in terms of the concepts they have, actually, some of the many of the restaurants are quite successful, but they're space constrained. And maybe this is getting a bit too micro, but essentially, some of the restaurants are very successful, but they're limited on space because you've got less successful restaurants right next to them. And so what this management team is going to do is it will shut the unsuccessful restaurants, expand the space for the successful ones, and then probably shut down or greatly reduce the grocery and the retail space, which is very unproductive right now. And I did some estimates in my report in terms of what I think the restaurants are earning and what I think the grocery and retail is earning. And essentially, the successful restaurants are probably already earning what they need to in terms of dollar per square feet. But then you've got the unsuccessful restaurants below that, and then you've got the grocery and retail, which is very unproductive. And so that's really the mix shift that needs to happen.
So I agree with everything you said. I do believe that I have heard that there is some requirement to have some type of grocery in the Seaport building, or in the Tin building. So I don't think they can fully shut it down. But look, if you're in New York or if you're visiting, I'd encourage you to go. Like right now, they have this beautiful grocery store. You walk in and there's fresh fish laid out on ice and there's all these beautiful cuts of steaks and stuff. And I've been to the Tin building probably 7-8 times. I've never seen, not that not seen it doesn't mean, never seen one person, I've never seen one person aside from my daughter who was about 15 months at the time, even look at the fish. Like there are these beautiful cuts of fish, right? So even if they shrink that footprint a little bit and change it from, again, fish on ice on display is taking up a ton of space and it's got to be such huge costs. Change that. Like there's just so many. Do you want to talk about the kitchen consolidation? Because I think that's just another really interesting example of maybe the Jean-Georges misincentives and one way to drive costs down.
Yeah. So actually, just one other point on the revenue side I forgot to make. I should probably make. So one of the things I did is I looked at other concepts in New York food halls. some which had been successful, some which were similar. And I tried to understand, what are they earning currently per square feet? So you've got very successful concepts like Chelsea Market and Italy and Flatiron. Those are generating between $2,000 and $2,400 per square feet in revenue. The Tin Building is at $600. Now, you could say, well, Chelsea Market is an iconic location, it's in the perfect place and so on. But actually, on the west side of Manhattan, there's Pier 57, which is also on the water. It's also got a highway. And actually, that's earning probably $900 per square feet in revenues. And that's actually run by a non-profit. So it's not even trying to profit maximize. So there is actually quite a similar situation in Manhattan that is earning 50% more in revenues per square feet. So just to give you a sense that this is absolutely achievable. It has been achieved in other parts of Manhattan. Just on the cost side of things, to give you sort of the, right now, every concept effectively operates independently. And so you've got a head chef for each one. You've got individual procurement, and that is incredibly inefficient. And the management are going to do two things. First of all, they're going to reduce the number of concepts, and that's going to consolidate that. And then they are going to effectively run them as one and buy as one unit rather than as 15, 20 different units. And I think that is going to make a very significant difference in terms of procurement cost. Because if you look at the cost structure of the company, of the Tin Building today, labor is about 80% of revenues, and sales per employee are massively. The number of employees is massively more than they should be with that amount of sales. So sales per employee is significantly higher at other food halls. You've then got a lot of general and administrative expense, a lot of other expenses. It's not exactly clear what they are. So there are a lot of expenses here that are not to do with food and beverage or retail. And I think there's a lot of cost-cutting potential. And the management have already begun doing that. You mentioned that there was an article earlier in January. The company did do a reduction of the employee base, I think by about 20%. I'd have to check the exact numbers, and maybe a little bit higher than that, because they might rehire some people to fill those positions. But there's really a lot of scope for cost reduction, and I think this is pretty much all within management's control.
No, that's great. I mean, and again, if you got the Tin Building to break even, it's a huge win from here, because you are the landlord as well, so you'll be making money on the rent there. Now, that's kind of like fixed costs but just bring it down to break even, and I think everything else to this can really shine through. And again, it's not going to happen overnight, but I think the cost cuts come in, and they come in quick. And I went to the Seaport maybe 2 weeks ago, 3 weeks ago. I'm sure you've been recently. When you go right now, there are a lot of concepts that have been shut down or are going to get shut down. So yes, the traffic isn't where you want it to be, but shutting down these unprofitable concepts is in process. And then you expand the profitable concepts, maybe bring some new ones in. That gets the cash burn under control. And hopefully over the next 18 months, as Meow Wolf kicks in, people see that, like, hey, we can get spots at the restaurants we actually want to eat, versus the popular restaurants are completely full and the unpopular restaurants are empty. Yeah, hopefully it spurs that. Anything else you want to talk about on Tin Building, or should we talk about some of the other assets here?
Yeah, just one more, just in terms of the actual management of the Tin Building. If you look at the employees of the Tin Building, nearly the entire senior management has changed in the last 12 to 18 months. And that includes a lot of people who are coming from Italy, which has run multiple 3 quite successful locations in New York. So, that's just another thing to point out.
Perfect. Let's talk about some of the other assets here. We can talk about some of the other assets in Seaport. We haven't even talked about the Vegas assets yet, which I think there's a significant amount of value there. You know what? We probably have to go 250 Waters. This is probably the other big asset, and the other thing that I thought we had great news in the earnings report for. So why don't we talk 250 and then we can go to the other ones?
Yeah, so 250 is also in the Seaport neighborhood. It's currently an undeveloped plot of land, but it has been zoned and fully approved for 545,000 square feet of mixed-use space, mostly residential. So these are going to be apartment buildings overlooking the Brooklyn Bridge and the East River, and also some commercial space, which could be used for office. It could be used for other commercial purposes, and then maybe a little bit of retail on the ground floor. So just maybe at a high level, it's very rare to find a plot of land of this size in Manhattan, where you don't have to demolish an existing building. It's fully approved, and it has what's called a 421A tax credits, which essentially means that you don't have to pay property taxes on the residential portion of the building. That makes a really big difference in terms of the economics for a developer. So this is really sort of prime real estate in a sort of great location, and it should be a very valuable piece of land. And Seaport is not really the best company to construct this building. I think the management's expertise is, unlike Howard Hughes, is not really in building buildings, but actually building consumer and entertainment concepts. And so I think the likely outcome, which they talked about in their recent results, is to explore either a full sale of this asset or some type of joint venture with a partner who would basically go about the actual work of construction and development. I think this would be particularly a sale would be a very significant win for this company. You can do different maths on what the developer economics are, and so there's a lot of different ways you could try and figure out the value of this asset. But I think this could sell for something like $160 million. Some people have much higher estimates. As I say, it's more of an art, frankly, than a science to know exactly what it will go for. But just to give you the context on that, remember, $160 million, they have a $60 million non-recourse mortgage on it. That's about $100 million, net. The entire market cap of the company, is just over double that. So this could be a very significant catalyst for the stock. And I don't know the timing, but I would imagine that they've been having discussions, ever since the spinoff, maybe even beforehand. And there's really no reason to wait. This is fully approved. It's ready to go. Construction costs go up over time. So I would imagine that they are going to look to sell or JV this as soon as possible.
No, look, I think you're 100% right. I believe I had a friend who told me he's got access to commercial real estate listings. And I think he said he's seen the listing pop up in the very recent past. So I think there's progress being made there. And if I remember correctly, the 431A program, you do have to get it built. So it's not like you could build it. Let's hypothetical. You couldn't start building it in 2050 and have it up in 2059 and be like, all right, where's our tax credits, right? There is an expiration date. You have to have it built before then. So I think it doesn't have to be tomorrow. It doesn't have to be the next day. But I would probably guarantee that this is going to be resolved in the next 2 years, because if they don't, you start risking those tax credits. And as you said, there's a huge value. So I think this is a near to medium term thing. And as you said, if you ask me what would you prefer, bring that cash in the door. Maybe I'd love that cash in. But it should be, if they said, hey, we got 100 million of cash, let's say, or hey, we got a 20% equity stake where the other guy's going to cover everything, and at the end we own 20% of the building, they actually should be equivalent, right? Now, I like the bird in the hand, but you could say, hey, 20% of a building, the other guy funds everything, he's on the hook for all the cost overruns, and we just continue to own a stake in this environment that should get better as 250 Water comes on and brings on hundreds of residents, and as Meow Wolf drives people, might be an interesting thought there too. Anything else on 250? Yeah.
No, I just think the way I look at it is this building, and then there's another building which is fully leased up. Those two, if you add them together, are probably worth the entire market cap of Seaport today. And so I think they're actually quite important, not because they're as interesting and then, as a standalone, not as valuable, but I think you can quite reliably estimate what their values are. And because that's actually very similar to what the market cap is today, I think that really, makes the risk reward of this investment attractive, in my view.
Speaking of things that are worth, it's not worth the market cap, but it might be worth the EV. Why don't we quickly talk about the Vegas assets?
Yeah. So they have some, quite different assets in Vegas. So they own the Las Vegas ballpark and the Aviators, which is AAA baseball team. And they also own air rights above the Fashion Show Mall, 80% of them. So Brookfield owns the other 20%. And, it's tricky with these assets. So in my valuation, I actually haven't put any value on the air rights. Now, some investors think that this could be one of the most valuable assets. You've got it's in a great location in Vegas. You've got a natural developer in Brookfield who's right there and who could buy these and develop that site. But it's sort of binary. Either this transaction will happen and it could be very accretive, or it won't, and investors probably are not going to give it value until that point. And there are hotels coming on in Vegas all the time, and I think the pipeline over the next couple of years is pretty full, which might make it less likely for a Brookfield to decide to develop a hotel or some other property there. But again, it could happen at any point. You sort of don't really have visibility on that, and it could be significant.
The nice thing about the air rights is I have fallen into your camp. I know people who thinks these are worth a lot. I am very skeptical. But the nice thing about the air rights is it is a free call option because there's basically no cash burn associated with them. And I don't think there's any time limit on them. So who knows? All you need in the next 20 years is Vegas to get really hot for one period in time and somebody say, hey, we must build something right here. And their rights, if they're worth 20 million, I'm just throwing out a number, right? 20 million, that's 10% ish of the market cap right now. And you and I are both putting that at zero. Like, it's just, there's so many different things in here. You mentioned the ballpark and the team, but I don't think you mentioned, there are some ways to kind of rough estimated value. Do you want to throw that out there?
Yeah, I just in terms of the capital that was invested, is about 150 million in the ballpark. The baseball team, it's hard to get the numbers because it was actually quite a while ago, but the number I came to was about 25 million. Mm-hmm. It's difficult with these sporting assets, how much of it was bought for, an appreciation in value versus other reasons. Difficult to know, but just to add those two numbers, the cost was $175 million. And I do think that, there is room to utilize the ballpark more. I know that that's something that the management are very keen to do. And 175 million is not far off the total market cap of the company today. Now, there is a bit of debt associated with the ballpark, but the point is it's potentially very significant and not something that I frankly have put too much value on, and probably not other investors as well. The other thing is the major league team, the A's are, which is the Aviators, the sister team with the A's. The A's are moving to Vegas in the next few years. Now, I think some investors have said, could this cannibalize attendance at the ballpark? The people I've spoken to have said in situations where this has happened in the past, and I think it's actually happened to a team in Vegas before, it's actually increased the attendance because people can see the young players that are ultimately going to move up to the major league, and or the injured players who are coming back. They can see those in the minor league team. And so there have actually been quite a lot of instances where it's boosted attendance, but we'll see what happens.
A reminder that today's podcast is sponsored by Fintool.com, the chat GPT for SEC filings and earnings transcripts. Just ask your question and Fintool will pull the best answer from the relevant documents, whether it's a snippet from an earnings call or a key point from a filing. If you're an analyst or portfolio manager, try Fintool today at Fintool.com and take your research to the next level. That's Fintool.com.
No, look, it makes total sense to me that it would kind of boost attendance because it should boost awareness of baseball around there. I think the product of a AAA team versus a major league team is just so different. Like, you go to the AAA team, maybe this is just me. I would go to AAA when I was in high school because we had nothing better to do. The tickets are crazy cheap, right? You almost go for free. And then when we got in college, it was like, hey, we can drink 4 beers for, it's not stadium pricing. It's more expensive than if you bought it at a grocery store, but you can just be drinking 4 beers and hanging out versus a professional team, you're going for like, that's a different experience, different field. But I think you're right. I don't know. But, I just, again, it's another thing. You kind of threw out 175 million at cost. Call it half of cost. Boom, you're a third to a half of the market cap. Like, how many things have we mentioned in here that are conservative assumption, take a haircut? It's the third step. It's one of the reasons I love this stock so much. Let's quickly go back to Seaport District. There are other assets in there. Obviously, we can't hit everything, but they own the historic district. They've got a few more JVs in there. They've got some leased up buildings. Just quickly, if there's anything in there you want to talk about or anything.
Yeah, so I mean, the historic district is a cobblestoned area of Manhattan. It's almost a block of space, quite unique actually to find that in Manhattan. I would compare it a bit to the meatpacking district. There's a lot that can be done there. Right now, that space has a lot of retail stores that aren't as busy as they really should be. There are a lot of empty spaces where retail stores should be. So there's a lot that could be done, and this is where, as Pier 17 draws people to the area, there are going to be a lot of opportunities to add stores and monetize that. The one thing I would highlight is there is one particular building called the Fulton Market Building.
Yep.
It is 115,000 square feet. It's fully leased up. The reason that's important is there are three tenants. They've disclosed the economics for one of them. The Lawn Club, which is a concept that Seaport has a JV with, is another tenant, and then there's a third tenant in that building. So they don't give you the economics for all the leases, but they do give you, some of them. And so my guess is that they're earning about $85 per square feet in this building, which is about $10 million in revenue. If you assume that converts to, let's say, 6.5%, 6.5 million in EBIT, so 65% conversion. And then you put a 6% cap rate on that, which would be quite sort of normal for this type of building in Manhattan. That would be $110 million in value. Let's call it 100. Again, that's half the market cap today. If you add that plus 250 Water Street, you get the whole market cap today. And this is a fully leased up building with fairly long-term leases. And so I think the value can be quite reliably estimated. Which is why I think it's actually important.
Look, I completely agree with you. Let me end with one question. I keep looking at this thing, and again, I am long it, so people know my disclosure, know where my bread is buttered here. I keep looking at this thing, and I say, look, they've got all this cash on the balance sheet. You gave the total debt number, but most of the debt is non-recourse associated with 250. So in a disaster, like, they're actually quite cashed up here. All these different assets and everything. And I keep saying, Andrew, if you look back 5 years from now, how are you going to have taken a material impairment on this investment? And I have some ideas, and I personally think and hope they're far-fetched, but I'd love to ask you the same question, because the thing that really attracts me here is I see lots of ways to win and possibly win big, given all the numbers that they're out, and it's hard for me to see the ways to lose. So I'd love to talk to you about how you see the ways to lose.
Yeah, well, I think it's important to say, obviously, at this point in time, it is a cash burning company. And so we are assuming that changes. And if that does not change, then of course, that will, very heavily impact the value. They could ultimately burn the cash they currently have and need even more cash. So that would really be the primary way you could lose from this point. And so, what would it take for them to never break even and just keep burning cash forever? I think, the tin building is about half the cash burn today. So if they are just unsuccessful in turning that around, which would mean that expanding successful restaurants doesn't necessarily bring in the actual revenue you would anticipate, it would mean that as you make these cost cuts, that has an impact in the service level and the number of customers coming in. Even though benchmarks, food halls in New York have been able to support that amount of revenue with those employees. So I think that would have to happen. And then you would need, for example, Meow Wolf to not be successful. We think it'll be successful because it's been successful pretty much everywhere else, but there's always a risk when you bring in a new concept that it just doesn't translate to the local audience. So I think, that would be another way. And, they could always do something dumb with the cash they currently have. That's unfortunately been how we've ended up in the situation where these assets are in need of a turnaround.
And unfortunately, most of the companies I invest in really love to do dumb stuff with their cash. That's one of the tough things. But to your last point, Ackman owns 40% here, and we talked about the Ackman possible discount that's getting assigned. You'd hope Ackman is a very sophisticated financial player. You'd hope if the management team came and said, "Hey, we want to spend all of our cash on, buying a piñata and cracking it open or something," you'd hope Ackman say, "No, like this cash, it will be deployed in rational manners, whether that's good acquisitions, buying buildings, investing in tenant improvements to get this spurred up, or maybe once they cut all the cash burn, saying, hey, let's turn this into a capital return story." I don't know, but you'd hope like the bad thing that we talked about earlier actually works in your favor.
And this management team has been brought in on that mandate. I mean, they are not here to, they don't have the same mindset as the previous management team. If you look at the Tin building, which is probably the kind of most egregious example of the philosophy that was previously taken to build this kind of really luxury food hall in the wrong place, this management team are not wedded to that idea. They are going to change things quite drastically. And so I think it's good that you have new people coming in who don't have the same ideas.
Chris, this has been awesome. If I can toot your horn one more time, I think I put it in my yearly review, but last year I did a podcast with you. What was the second podcast we did?
Watches of Switzerland. And
I did a Watches of Switzerland podcast with you. And then the next day, my friend Kyle Mowry came on and we did a Driven podcast. And I had so much fun and learned so much on them. I was like, look, we're high grading the guests. Like anyone, they've got to be Chris Waller and Kyle Mowry quality, though it's tough to match that. But look, Chris, this has been great. I guess let's wrap it up with this. We covered a lot here. Actually, there is a lot more that we could cover here because there's just endless thing. But I think we did hit all the main things. But any last thoughts you want to hear? Anything you think we should have hit that we didn't hit?
No, I think it's a small company by market cap, but unusually complicated. And that is partly why the opportunity exists. And I think that as we see some of these changes that management have made take hold, I would hope that the stock will start, pricing that in. I think there's maybe been a bit of frustration so far because if you look at Q4 results, there hasn't really been a significant improvement. But bear in mind that is before all these changes have been made. The changes at the Tin building were in Q1. These leases, they're going to come in at a later date. So there is a time that we have to wait and be patient.
I'll just use myself. When I first saw the results, I was like, damn, I thought this management team understood get the cash burn. And then I thought for 30 seconds and I was like, hey, this is real estate. They just took it over. The spin basically happened in Q4 and they're reporting Q4 results. It was basically 6 months ago. This is real estate. It takes a little time for them to come in. They have to restructure leases. Tin building, I guess you could, but it's not like you can just throw in this is closed and we're redoing everything. You have to, it takes a little bit of time. And I would just say when I had more than 30 seconds to be the headline Bloomberg flash, here is the cash burn, I was personally, especially the Meow Wolf and a lot of things, I was really impressed. And I think they are clearly driving in the right direction. I hope you agree, but if you disagree, please tell me otherwise.
Yeah, no, I agree. And, obviously I own the stock as well, but I think that these changes had not happened prior to Q4. So, then why would the results be much better if the changes were afterwards? So
they filed the 8K that said, hey, we took over CCMC that operates everything. They filed the 8K beginning of January, and I think it was as of January 1. So it's like, how could the cash burn in Q4 have been better? You kind of knew it.
Yeah. And also bear in mind, some of these things, they do have to spend up front. I mean, when you reduce the number of staff significantly, you do have to pay severance. When you close concepts, there is a period of time when they're shut and earning zero. When you spend to bring in these new, whether it's new restaurants or so on, you have to spend up front. But those are the right decisions to make. And so there is a bit of cost up front, but that's what we should want them to do.
The Meow Wolf thing that you and I both think is like a borderline grand slam, Meow Wolf's not going to be here until 2027. So it's coming, but guess what? It's not going to be in the results for the next 21 months. unless, some tenants that can move in quicker say, oh, Meow Wolf's coming, let's grab some leases now. But Meow Wolf, which I think is transformative, doesn't come for 21 months. Chris, way over an hour here. I really appreciate you popping on. The weather is starting to get really nice in New York. So you, me, some of our friends, we're going to go down to Lawn Club, and I'm going to teach you guys how to. They've got the beer pong with giant trash cans and giant balls. We're going to play some of that. We're going to play some shuffleboard. It's going to be a ton of fun.
Yeah, looking forward to it. Thank you
Chris
again,
Waller,
Trav.
Hidden Gems, link to the Seaport, and all the stuff he writes is great, but link to the Seaport will be in the show notes. And Chris, looking forward to having you on for a fifth time, get you this shirt. So you're getting there.
Great. Thank you, Andrew. Thanks for having me. Thanks to everyone listening.
Later, buddy.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.